All right. Happy Fed Day, everybody. Good afternoon, everybody, and happy Fed Day, everyone. It's December 13th, 2023, and the news just hit the tape a few moments ago. The Fed has left interest rates unchanged. No big surprise there. We weren't expecting a rate hike. The odds of that were virtually zero going into this meeting. But the big news, the news that has the S&P 500 on a tear right now, you may notice from that chart over my head, is the fact that the Fed, I'm guessing in their summary of economic projections, aka the dot plot, they forecast as many as 3 rate hikes in 2024, which is more dovish, more easy monetary policy than the market was expecting. And as the market digests that news, stocks are rallying, gold is rallying, the dollar is falling, interest rates on the 10-year Treasury is falling. That's bond prices going higher. In other words, Powell hasn't even started talking yet, and we've got a dovish Fed today. Now, we'll see. We've seen this in the past before where the market takes this initial reaction and they run away with it. Everything goes higher, and then Powell says something during the press conference, and it reverses lower, ends up settling unchanged. There's a lot that's going to happen in the next hour or so, so it's really hard to tell where we're going to come out of this. We'll have to see what Powell says. But the big takeaway so far was that that projected 3 rate cuts next year in the Fed's dot plot. That is what everybody is focusing on at the minute, and that's got everything going higher. In the meantime, we've got my man, Mish the Mod, is here with us in the background right now. I got him on audio only because it takes a lot to get the green screen and everything set up for this stream. But Mish, how we doing today, brother?
And I'm doing so good I couldn't be complaining about it. Down here in Costa Rica, the internet is kind of iffy at best, but I do tell you that it's nice and sunny, about 80 degrees.
I am living vicariously through my moderator with that nice sunny 80 degrees. So, Mish, what are you looking for today in this press conference? Is there anything that you're thinking he might hint at or allude to? Is there any key phrases you're looking for? What do you think?
I think he's going to start beating down again on the we may or may not raise again, even though the dot plot says they're lowering. He's not ready to give up the ship. He's going to continue tightening. They haven't even talked about the selling of Treasury in a year. He hasn't mentioned it at all. No one's questioned it. There may have been one question this summer, but that's what I'm looking for. The rate hikes are kind of in the past now. I'm worried about what he's going to be buying and selling.
Yeah, that's a couple of really good points there. Especially the rate hikes are probably done now. I think you're probably right. If they're already starting to forecast cuts next year, pretty clear we're done with the rate hikes. He may say something like additional tightening may be appropriate if conditions to call for it or something like that. He may make one of those qualifying statements. So I don't think the market is really going to care about that. Powell did try to come out a few weeks ago. I forget where it was. It was at some college. He made a speech, but he tried to come out very hawkish, and the market just ignored him and went higher. So if Powell's goal here is to come out hawkish and temper enthusiasm somehow, he's got his work cut out for him. It's also a really good point about QT. We haven't heard a lot about quantitative tightening or money destruction in almost a year now. And well, maybe today is the day he talks about that, because if we're done with the rate hikes and rate cuts are coming at some point, we don't know when, then obviously QT seems like the next logical step that we would talk about. My morning live stream this morning, we talked about how there was that article in Reuters that was saying when the reverse repo gets down to $625 billion, that's when the Fed might back off of their quantitative tightening, and that they expect that in the third quarter of next year. Probably not going to happen. Well, we've got Powell coming up to the podium here. So I am going to hand the mic off to Uncle J Powell. We'll see what he has to say if and when that time comes. He's not here yet. Powell will give some brief statements for a couple of minutes, and then we'll go to those pre-approved, pre-screened questions from the press that, of course, Powell sees them coming, and we'll see what happens there. But the big takeaway so far, over my head, we'll be changing those charts as we go. We're going to go through the S&P, the Dow, the NASDAQ, the 10-year, gold and silver. So we'll be changing those charts as we go through. But at the moment, almost everything is up right now. Gold is up $28. The Dow is up 236 points. The DXY is down. And still no Jay Powell at the podium. Here he comes. There's Jay Powell. All right, let's see what Powell has to say today.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. Here, it's natural to look first that has been made toward our dual mandate objectives. Inflation has eased from its highs, and this has come without a significant increase in unemployment. That's very good news. But inflation is still too high. Ongoing progress in bringing it down is not assured, and the path forward is uncertain. As we look ahead to next year, I want to assure the American people that we're fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. Our actions have moved our policy rate well into restrictive territory, meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening likely have not yet been felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks that we face, the committee is proceeding carefully. We will make decisions about the extent of any additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has slowed substantially from the outsized pace seen in the third quarter. Even so, GDP is on track to expand around 2.5% for the year as a whole, bolstered by strong consumer demand as well as improving supply conditions. After picking somewhat over the summer, activity in the housing sector has flattened out and remains well below the levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our summary of economic projections, committee participants revised up their assessments of GDP growth this year, but expect growth to cool, with the median projection falling to 1.4% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 204,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth appears to be easing, and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises somewhat from 3.8% at the end of this year to 4.1% at the end of next year. Inflation has eased over the past year, but remains above our longer run goal of 2%. Based on the Consumer Price Index and other data, we estimate that total PCE prices rose 2.6% over the 12 months ending in November, and that excluding the volatile food and energy categories, core PCE prices rose 3.1%. The lower inflation readings over the past several months are welcome, but we will need to see further evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. As is evident from the SEP, we anticipate that the process of getting inflation all the way to 2% will take some time. The median projection in the SEP is 2.8% this year, falls to 2.4% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points, and we have decreased our securities holdings by more than $1 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. While we believe that our policy rate is likely at or near its peak for this tightening cycle, the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. We are prepared to tighten policy further if appropriate. We're committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we're confident that inflation is on a path to that objective. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. While participants do not view it as likely to be appropriate to raise interest rates further, neither do they want to take the possibility off the table. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of 2024, 3.6% at the end of 2025, and 2.9% at the end of 2026, still above the median longer-term rate. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. In light of the uncertainties and risks and how far we have come, the committee is proceeding carefully. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. In determining the extent of any additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run.
That and inflating
To
asset
conclude,
values.
we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Chris Rugaber at Associated Press. I wanted to ask, how should we interpret the addition of the word any before additional firming in the statement? I mean, does that mean that you're pretty much done with rate hikes and the committee has shifted away from a tightening bias and toward a more neutral stance? Thank you.
So specifically on any, we do say that in determining the extent of any additional policy firming that may be appropriate, so any additional policy firming, that sentence. So we added the word any as an acknowledgement that we believe that we are likely at or near the peak rate for this cycle. Participants didn't write down additional hikes that we believe are likely, so that's what we wrote down. But participants also didn't want to take the possibility of further hikes off the table. So that's really what we were thinking.
Devoted a whole question to the word any. That's great.
Steve Leisman, CNBC. Happy holidays, Mr. Chairman. Fed Governor Chris Waller said that if inflation continues to fall, then the Fed in the next several months could be cutting interest rates. I wonder if you could comment on whether you agree with Fed Governor Waller on that the Fed would become more restrictive if it didn't cut rates if inflation fell. Thank you, sir.
So of course, I don't comment on any other officials, even those who work at the Fed. But I'll try to answer your question more broadly. So the way we're looking at it is really this. When we started out, right, we said the first question is how fast to move, and we moved very fast. The second question is really how high to raise the policy rate, and that's really the question that we're still on here. We're very focused on that. As I mentioned, people generally think that we're at or near that, and think it's not likely that we will hike, although they don't take that possibility off the table. So that's when you get to that question, and that's your answer. There's a naturally it begins to be the next question, which is when it will become appropriate to begin dialing back the amount of policy restraint that's in place. So that's really the next question, and that's what people are thinking about and talking about. And I would just say this: we are seeing strong growth that appears to be moderating. We're seeing a labor market that is coming back into balance by so many measures, and we're seeing inflation making real progress. These are the things we've been wanting to see. We can't know. We still have a ways to go. No one is declaring victory. That would be premature, and we can't be guaranteed of this progress. So we're moving carefully in making that assessment of whether we need to do more or not. That's really the question that we're on. But of course, the other question, the question of when will it become appropriate to begin dialing back the amount of policy restraint in place, that begins to come into view and is clearly a topic of discussion out in the world, and also a discussion for us at our meeting today.
Did Powell just tell CNBC that they forgot one of their questions?
Sure. So it comes up in this way today. Everybody wrote down an SEP forecast. So many people mentioned what their rate forecast was, and there was no back and forth, no attempt to sort of reach agreement. Like, this is what I wrote down, this is what I think, that kind of thing, and a preliminary kind of a discussion like that. Not everybody did that, but many people did. And I would say there's a general expectation that this will be a topic for us looking ahead. That's really what happened in today's meeting. I can't do the head count for you in real time, but that's generally what happened today.
Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. At this point, can you confidently say that the economy has avoided a recession and isn't heading for one now? And if the answer is no, I'm curious about what you'd still be looking for.
I think you can say that there's little basis for thinking that the economy is in a recession now. I would say that. I think there's always a probability that there will be a recession in the next year, and it's a meaningful probability no matter what the economy is doing. So it's always a real possibility. The question is it? So it's a possibility here. I have always felt since the beginning that there was a possibility, because of the unusual situation, that the economy could cool off in a way that enabled inflation to come down without the kind of large job losses that have often been associated with high inflation and tightening cycles. So far, that's what we're seeing. That's what many forecasters on and off the committee are seeing. This result is not guaranteed. It is far too early to declare victory. And there are certainly risks. It's certainly possible that the economy will behave in an unexpected way. It has done that repeatedly through in the post-pandemic period. Nonetheless, where we are is we see the things that I mentioned.
I'm curious, if you're looking back on the past year, you talked about navigating by the stars under cloudy skies. Can you talk about some of the ways in which the economy surprised you most this year, where you thought it would behave in one way and had to pivot to respond? Thanks.
So I think forecasters generally, if you go back a year, were very broadly forecasting a recession for this year, for 2023. And not only did that not happen, that includes Fed forecasters and really essentially all forecasters, a very high proportion of forecasters were expecting very weak growth or a recession. Not only did that not happen, we actually had a very strong year. And that was a combination of strong demand, but also real gains on the supply side. So this was the year when labor force participation picked up, where immigration picked up, where the distortions to supply and demand from the pandemic, the shortages and the bottlenecks really began to unwind. So we had significant supply side gains with strong demand, and we got what looks like a 2.5% plus or a little more than that growth year at a time when potential growth this year might even have been higher than that just because of the healing on the supply side. So that was a surprise to just about everybody. I think the inflation forecast is roughly what people wrote down a year ago, but in a very different setting. And I would say the labor market, because of the stronger growth, has also been significantly better. If you look back at the SEP from a year ago, there was a significant increase in unemployment. That didn't really happen. We're still at 3.7%. So we've seen strong growth, still a tight labor market, but one that's coming back into balance with support from the supply side, a greater supply of labor. It's that's what we see, and that I think that combination was not anticipated broadly.
Congratulations, everybody. You're having a strong year, in case you didn't know that already.
Thanks, Howard Schneider with Reuters, and thanks for taking the questions. I wonder if you could give a little more color or detail on what motivates the lower rates next year, whether it's a coincidence, for example, that the spread between PCE inflation, core inflation, and the federal funds rate stays constant over the year. Are you simply calibrating against the fall in prices, in the price level that you're expecting, in the rate of inflation that you're expecting, as opposed to supporting the economy?
Nothing quite that mechanical is happening. The SEP really is a bottoms up, built from the bottom up, right? So I think people are looking at what's happening in the economy. And I think if you look at the big difference from September in the SEP, the expectations for inflation this year, both headline and core, have come down, really significantly in 3 months. That's a big piece of this. At the same time, growth is turned out to be very strong in the third quarter, is slowing, we believe, as appropriate. And we've had several labor market reports which suggest, again, significant progress toward greater balance across a broad range of indicators. You're seeing so many of the indicators coming back to normal, not all of them. But so I think that people look at that and they write down they basically each individual writes down a forecast and a rate forecast that goes with that forecast. We tabulate them and publish it. And so it isn't, you ask about real rates, I take it, that is something that we're very conscious of and aware of and monitor. And it's certainly it's a part of how we think about things, but really it's broader financial conditions that matter. And as you well know, it's so hard to know exactly, what the real rate is or exactly how tight policy is at any given time. So you couldn't follow that like it was a rule and think that you would get the right answer all the time. But it's certainly something that we're focused on. And indeed, if you look at the projections, I think the expectation would be that the real rate is declining as we move forward.
It sounds like the discussion over that, if I could follow up, has already kind of begun. I'm wondering, just related to Steve's question, how the tactics of this play out, given the slowing of inflation and the fact that the deeper you get into 2024, the closer you get to a presidential election. Do you want to front load this, in other words?
Yeah, no, we don't think about political events. We don't think about politics. We think about what's the right thing to do for the economy. The minute we start thinking about those things, we just can't do that. We have to think, what's the right thing? We'll do the things that we think are right for the economy at the time when we think is the right time. That's what we'll always do. So I mentioned we're moving carefully. One of the things we're moving carefully about is that decision over that assessment, really, over whether we've done enough, really. And you see that people are not writing down rate hikes. That's us thinking that we have done enough, but not feeling that really strongly, confidently, and not wanting to take the possibility of a rate hike off the table. Nonetheless, it's not the base case anymore, obviously, as it was 60, 90 days ago. So that's how we're approaching things. And you know, as I mentioned, we wrote down this SEP, and it talks about it. People have individual assessments of when it will be appropriate to start to dial back on the tight policy we have in place. And that's a discussion we'll be having going forward. But that's another assessment that we're going to make very carefully. So as time goes forward.
10-year yield, 4.0%. This is very dovish, folks. Everything is rallying right now.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've argued over the last year that policy tightening started before you actually lifted off because the market anticipated your moves and tightened on your behalf. The market is now easing policy on your behalf by anticipating a funds rate by next September that's a full point below the current level, with cuts beginning around March. Is this something that you are broadly comfortable with?
So this last year has been remarkable for the sort of seesaw thing back and forth we've had over the course of the year, of markets moving away and moving back and that kind of thing. So, and what I would just say is that we focus on what we have to do and how we need to use our tools to achieve our goals. And that's what we really focus on. And people are going to have different forecasts about the economy, and those are going to show up in market conditions, or they won't, but in any case, we have to do what we think is right. And, in the long run, it's important that financial conditions become aligned or are aligned with what we're trying to accomplish. And in the long run, they will be, of course, because we will do what it takes to get to our goals. And ultimately, that will mean that financial conditions will come along. But in the meantime, there can be back and forth. And, I'm just focused on what's the right thing for us to do. And my colleagues are focused on that, too.
The markets seem to think inflation is coming down credibly. Do you believe we're at the point where inflation is coming down credibly?
Listen, I welcome the progress. I think it's really good to see the progress that we're making. I think if you look at the 12-month measure, look at the 6-month measures, you see very low numbers. If you look at 12-month measures, you're still well above 2%. You're actually above 3% on core through November at PCE. That isn't to say I'm not calling into question the progress. It's great. We just need to see more. We need to see continued further progress toward getting back to 2%. That's what we need to see. So it's our job to restore price stability, and that it's one of our two jobs along with maximum employment, and they're equal. So we're very focused on doing that. As I mentioned, we're moving carefully at this point. We're pleased with the progress, but we see the need for further progress. And I think it's fair to say there is a lot of uncertainty about going forward. We've seen the economy move in surprising directions, so we're just going to need to see more further progress.
It's the closest thing to a hawkish statement he's made so far today. This has been very dovish otherwise. We'll see if that changes direction here.
New York Times. Thanks for taking our questions. In the SEP from today, growth is notably below potential in 2024. If growth were to surprise us again in the way that it has for years now by being stronger than expected next year, would it still be possible to cut rates? Or put another way, is below trend growth necessary to cut rates, or would continued progress on inflation alone be sufficient?
So we'll look at the totality of the data. Growth is one thing. So is inflation. So is labor market data. So we look at the total as we make decisions about policy changes going forward. We're looking at all those things, and particularly about as they affect the outlook. It's ultimately all about the outlook and the balance of risks as well. So that's what we'd be looking for. If we have stronger growth, that'll be good for people. That'll be good for the labor market. It might actually mean that it takes a little longer to get inflation down to 2%. We will get it down to 2%. But if we see stronger growth, we will set policy according to what we actually see, and so that's how I would answer.
I guess the question I'm asking, if you don't mind a quick follow-up, I guess the question I'm asking is above trend growth itself a problem?
It's only a problem it's not itself a problem. It's only a problem insofar as it makes it more difficult for us to achieve our goals. And if you have growth that's robust, what that will mean is probably will keep the labor market very strong. It probably will place some upward pressure on inflation. That could mean that it takes longer to get to 2% inflation. That could mean we need to keep rates higher for longer. It could even mean ultimately that we would need to hike again. It just is, it's the way our policy works.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. How do you interpret the state of the labor market right now, and in particular evidence that it's coming into better balance? What would you need to see to conclude that it has reached that balance?
So on the better balance side, there's just a lot of things. It's you see job growth still strong, but moving back down to more sustainable levels given population growth and labor force participation. The things that are not quite, but let me go on with that list. Claims are low. If you look at surveys of businesses, they're sort of the era of this frantic labor shortage are behind us, and they're seeing the shortage of labor as being significantly alleviated. If you look at shortages of workers, whereas they thought job availability was the highest it had ever been or close to it, that's now down to more normal levels by so many measures: participation, unemployment, so many measures, the unemployment, job openings, quits, all of those things. So wages are still running a bit above what would be consistent with 2% inflation over a long period of time. They've been gradually cooling off, but if wages are running around 4%, that's still a bit above, I would say. And I guess there are just a couple of other, the unemployment rate is very, very low. And these are, but I would just say overall, the development of the labor market has been very positive. It's been a good time for workers to find jobs and get solid wage increases.
Yeah, can't let people get a raise. Can't let those wages catch up to the cost of living from a few years ago, right?
Yeah, I'd say the mood among economists at the moment seems to be one of cautious optimism, which is somewhat corroborated by your forecast, by this sense that we are going to have a soft landing. Yeah, then when we hear from the general public, there's a lot of discord about economic conditions. What do you think explains this disconnect, and does it matter for policymakers?
It may be. A common theme is that while inflation is coming down, and that's very good news, the price level is not coming down. Prices of some goods and services are coming down, but overall, in the aggregate, the price level is not good. So people are still living with high prices, and that is something that people don't like. And what will happen with that is wages are now, real wages are now positive, so that wages are now moving up more than inflation as inflation comes down. And so that might help improve the mood of people. But we see those public opinion surveys. The thing that we can do is to do our jobs, which is to use our tools to foster price stability, which has such great benefits over such long periods of time, and which is the thing that really enables us to work for and achieve an extended period of high employment, which is so beneficial for families and companies around the country.
Yeah, I'll talk a lot more about that answer in a little bit, folks.
Hi, Victoria Guido with Politico. I wanted to ask, on the flip side of if things start to deteriorate rapidly, if we do fall into a recession, if we do start to see unemployment rise at sort of the levels of inflation that we're seeing now, how would you all think about that in terms of rate cuts? Would that be a sign that you've done your job demand-wise?
Sorry, if
the economy looks like it's starting to fall into recession, if the jobless rate starts to rise?
That's not something we're hoping to see. Obviously, we're hoping to see something very different, which is continuation of what we have seen, which is the labor market coming into better balance without a significant increase in unemployment, inflation coming down without a significant increase in unemployment, and growth moderating without a significant increase in unemployment. That's what we're trying very much to achieve, and not something we're looking to see. obviously what we'll do is we'll look at the totality of the data, as I've mentioned.
This is a
couple
messed up
times,
question
and
she's
certainly
asking here. She's
the
asking,
labor
should the
data will be
market
important in
celebrate
that.
your
And,
economic
you know,
pain
if you
in not so many words?
you can describe a situation like that where if there were the beginning of a recession or something like that, then yes, that would certainly weigh heavily in that decision.
Michael McKee from Bloomberg Television and Radio. Mr. Chairman, you were, by your own admission, behind the curve in starting to raise rates to fight inflation. And you said earlier, again, the full effects of our tightening cycle have not yet been felt. How will you decide when to cut rates, and how will you ensure you're not behind the curve there?
So we're aware of the risk that we would hang on too long. You know, we know that that's a risk, and we're very focused on not making that mistake. And we do regard the two, you know, we've come back into a better balance between the risk of overdoing it and the risk of underdoing it. Not only that, we were able to focus hard on the price stability mandate, and we're getting back to the point where, which is what you do when you're very far from one of the two mandates. You're getting now back to the point where both mandates are important, and they're more in balance too. So I think we'll be very much keeping that in mind as we make policy going forward. And the things we'll be looking at, I've already described. You know, we're obviously looking hard at what's happening with demand, and what we see the same thing other people see, which is a strong economy, which really put up quite a performance in 2023. We see good evidence and good reason to believe that growth will come in lower next year. And you see what the forecasts are. I think the median growth, median participant wrote down 1.4% growth, but you know, we'll have to see. It's very hard to predict. We'll also be looking to see progress on inflation and you know, the labor market remaining strong, but ideally without seeing the kind of large increase in unemployment that happens sometimes.
When you begin the cutting cycle, will it be essentially run the same way you do it now with raising rates, where you basically do trial and error cut and see what happens? Or will you tie it to some particular measure of progress?
We haven't typically tried to articulate, with one exception, a really specific target levels, which was, some of you will remember the thresholds that we used in, I guess, 2013. The answer is, these are things that we haven't, you know, really worked out yet. We're sort of just at the beginning of that discussion.
Edward. Thank you, Mr. Chairman. Edward Lawrence of Fox Business. So if the Fed cuts rates, as the dot plot is showing, about 75 basis points, does that signal or that there's a belief of weakness next year in the economy?
It wouldn't, if that were, first of all, let me just say, that isn't a plan. That's just accumulating what people wrote down. So that's not something, you know this, but allow me to say it again. We don't debate or discuss what the right, you know, whose SEP is right. We just say what they are and we tabulate them and publish them. So, and it's, you know, it's important for people to know that, but it wouldn't need to be a sign of, it could just be a sign that the economy is normalizing and it doesn't need the tight policy. It depends on the economy can evolve in many different ways, right? So, but it could be more what I just described.
And you focused on core inflation. We've heard from in other meetings. How sticky is core inflation right now?
Well, that's what we're finding out, and we've seen real progress in core inflation. It has been sticky, and famously, the service sector is thought to be stickier. But we've actually seen reasonable progress in non-housing services, which was the area where you would expect to see less progress. We are seeing some progress there, though. In fact, all three of the categories of core are now contributing. Goods, housing services, non-housing services, they're all contributing at different levels, you know, meeting by meeting, or rather report by report. So, yeah.
I think there's plenty of data to contradict that last statement that he just made. Maybe there's some data points that support it.
Thanks for taking our questions. I just wanted to ask a little bit about, you know, we had some pretty positive data this morning and yesterday. I'm assuming those were not incorporated into the forecasts we see today. But I just wanted to ask, how that kind of adds to your thinking, on the inflation outlook.
Right. So we got CPI the morning of the first day, and we got PPI the next day, which informs the translation into PCE. So it's very, very late in the game, but nonetheless, participants are allowed to, encouraged to update their SEP forecasts until probably mid-morning today. After that, so staff has to accumulate all of that and create the documents that you see. So until about mid-morning, a little maybe late morning, it's okay to update. And I believe some people did update their forecasts based on what we saw today.
You see, how are you, when you think about, starting to think about the rate cuts next year or whenever they come, how do you think about the economy we're in now, kind of post-pandemic? Do you think that there's been significant structural shifts, and is that going to change how you look at a rate cut path?
The question of whether there have been fundamental structural shifts is a really hard to know the answer, and a very interesting one right now. The one that would affect, one that comes to mind though, is just the question of where the neutral rate of interest is. And so, for example, if it's risen, and I'm not saying that it has, but if it were to have risen, that would mean that interest rates would need to be a little bit higher to convey the same level of restriction. The thing is, we're not really going to know that. People will be writing papers about that 10 years from now and still fighting about it. So it's just that it's going to be uncertain. So we're going to be making policy in this, difficult, uncertain, really unprecedented environment. Someone once said that the natural rate of interest by its works, and that's really right. But that's very difficult because policy operates with a lag. So it's one of the reasons why we slowed down this year. We started slowing down at this meeting last year, reducing the pace at which we were adding restriction. And over the course of this year, we really slowed down a lot to give those lags time to work. In terms of demand, has demand shifted more away from services into goods? You can make a case for that the shift back into services has not been complete, and it doesn't look like it's ongoing, but I don't know if that's right. Maybe people just bought so much stuff that they temporarily don't want any more stuff. They haven't got any place to put it.
Or maybe they're broke, Jay, because the prices went up so much and they're spending half their paycheck on the rent.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said back in July that you needed to start cutting rates before getting to 2% inflation. As you mentioned, PCE inflation is now running at 3.5% on core. On a 6-month annual basis, core PCE is running at 2.5%. Though when you look at super core and shelter, they are, of course, stickier. So in looking at the different components of the data, how much closer do you have to get to 2% before you consider cutting rates?
I mean, the reason you wouldn't wait to get to 2% to cut rates is that policy would be too late. I mean, you'd want to be reducing restriction on the economy well before 2%, because before you get to 2%, so you don't overshoot. If we think of restrictive policy as weighing on economic activity, it takes a while for policy to get into the economy, affect economic activity, and affect inflation. So I can't give you a precise answer, but if you look at what's in the SEP, and I think you'll see a reasonable estimate of the time lags and things like that it would take.
3% would be reasonable.
I wouldn't want to identify any one precise point, because I would be able to look back then and probably find out that it turned out not to be right. But we'll be looking at it and looking at the broad collection of factors.
Hi, Chair Powell, Jean Young with Market News. Wanted to go back to the stickiness of inflation question. Over the past couple of years, a lot of central bankers have talked about the more difficult last mile of getting inflation back down to 2%. Yet it's also been surprising how fast inflation has come down this year. I'm curious, do you think something has changed in our understanding of inflation? Or do you subscribe to this notion still, or is it something different about the U.S. economy?
I think I think this, we felt since the beginning that it would be a combination of two factors. The first factor is just the unwinding of what happened in the pandemic, the distortions to supply and demand. And the second thing would be our policy, which was weighing on aggregate demand and actually making it easier for the supply side to recover because of lower demand. We thought those two things were going to be necessary. Sorry, say the last part of your question again.
If there was something different about the U.S. economy.
Yeah, so it's not that it may or may not be about the U.S. economy being different. I think that this inflation was not the classic demand overload, pot boiling over kind of inflation that we think about. It was a combination of very strong demand without question and unusual supply side restrictions, both on the goods side, but also on the labor side, because we had a participation shock. So this is just very unusual. And, we had the view, my colleagues and I broadly had the view that we could get a lot of, you had essentially a vertical supply curve because you ran into the limits of capacity at very low levels because there weren't workers and because people couldn't, the supply chains were all broken. So we had the view that you could come straight down that vertical supply curve to the extent demand reduced. And, something like that has happened. It happened so far. The question is, once that part of it runs out, and we think it has a ways to run, we definitely think that the sort of supply chain and shortages side has some ways to run. Does labor force participation have much more to run? It might. Immigration could help, but it may be that at some point you will run out of supply side help, and then it gets down to demand and it gets harder. That's very possible. But to say with certainty that the last mile is going to be different, I'd be reluctant to suggest that we have any certainty around that. We just don't know. I mean, inflation keeps coming down. The labor market keeps getting back into balance. And, it's so far so good, although we kind of assume that it will get harder from here, but so far it hasn't.
Okay, we're going to make it to the last question.
Hi, Chair Powell. Thanks for taking our questions. Megan Casella with Barron's. I want to ask about the balance sheet, given the Fed's focus now on proceeding carefully and considering rate cuts. And can you talk us through what the latest thinking is, and has there been any consideration of altering the pace of quantitative tightening at all?
We're not talking about altering the pace of QT right now, just to get that out of the way. So balance sheet seems to be working pretty much as expected. What we've been seeing is, that we're allowing runoff each month. That's adding up. I think we're close to 1.2 trillion now. That's showing up. The reverse repo facility has been coming down quickly, and reserves have been either moving up or as a result or holding steady. At a certain point, there won't be any more to come out of, or there'll be a level where the reverse repo facility levels out. And at that point, reserves will start to come down. We still have, that we intend to reduce our securities holders until we judge that the quantity of reserve balances has reached a level somewhat above that consistent with ample reserves. And we also intend to slow and then stop the decline in size of the balance sheet when reserve balances are somewhat above the level judged to be consistent with ample reserves. We're not at those levels. With reserves close to $3.5 trillion. We don't think we're at those reserves. There isn't a lot of evidence of that. We're watching it carefully, and so far it's working pretty much as expected, we think.
Adjusting that thinking at all by the time you're considering or moving forward with rate cuts? Is that time to rethink, or are you still going to follow that thinking?
So I think they're on independent tracks. So you're asking though the question, I guess you're implying the question of can you continue with QT at such time, QT, which is a tightening action, at such time as policy is still tight? And the answer is it depends on the reason. If you're cutting rates because you're going back to normal, that's one thing. If you're cutting them because the economy is really weak, So you can imagine you have to know what the reason is to know whether it would be appropriate to do those two things at the same time.
That was
Thanks
the
very
first
much.
mention of QT and reverse repo in a while. That was big. We'll talk about that too. Is he done now? Okay, he's folding up. He is done now. All right. So a lot to take in there. That last question in particular, that was pretty interesting. Let me pause here. Let me make some adjustments to my screen momentarily. I tell you, while I'm making my adjustments here, the biggest takeaway from that meeting is Dovey. I mean, across the board, that was the most dovish I have seen Jerome Powell since 2021, since before he started his tightening policy, since before he started the taper in November of 2021. I'm going to bring in my man, Mish the mod here, and we're going to talk about that a little bit. I mean, Mish, what was your takeaway from all of that? I mean, did you get the same thing I did there?
Well, I texted you right near the beginning. First off, as a short intro speech. Secondly, I felt like he was taking a victory lap, kind of.
Yeah, I got that too. You know, celebrating the progress that they've made. Substantial progress has been made. A lot of that lip service that he did. I agree with that sentiment. He took a bit of a victory lap early on. Notably, the market was rallying, and this was different from some prior Fed press conferences because we saw the market rally on the initial no hike and the initial, prospect of 3 cuts next year. And so the market starts going up. Now, historically, we've seen a break lower because he says something hawkish during the press conference, or they don't like the answer to some question. And we see, the algorithms take the market back down the other way. We didn't get that today. Market went up and it kept going up. S&P 4,700 while he was talking. The Dow broke 37,000 while he was talking. I mean, rocket fuel for markets, that meeting was it. Are you getting the same thing I'm getting from that?
I think that the markets heard exactly what they wanted to hear. That essentially, I know he kind of tried to sidestep it later on in the conference, but he said hiking's over, and we're going to sit here and watch and see what happens. And the market really, of course, liked that. And the Dixie went down too also.
Oh, yeah, the Dixie, looking at that on the chart, it was down at one point over a full one. I don't even know what the unit is, over a full 100 basis points at one point. Dixie's right now down 97 basis points on the day. And you can see it in the chart. I mean, the dollar, there's that big red candle initially on the announcement, and then it just keeps going lower. There was a couple of brief periods where it went a little bit higher, but we're talking, a little bit of a correction of 1 or 2 basis points before just slam right back down again. So, I mean, the dollar really weakened during that whole press conference. And, the whole time, about halfway through the press conference, I started to picture all those people who send me these questions. I get this comment a lot. I'm saving up to buy a house. A lot of millennials, even some Gen Zers now, I've been trying to save. I've been trying to buy a house. Prices just keep going up. Interest rates keep going up, unaffordability. And then I see this press conference, and I just don't know what to tell those people at this point now, because what Jerome Powell just did was he just blew a whole lot of hot air into the everything bubble. I mean, no doubt about it. Look at what interest rates just did. I mean, look at the 10-year Treasury yield, down 16 basis points. It was down 20 basis points at one point. Okay, so interest rates coming down, that's good for a borrower, right? Your mortgage rate on your house is coming down, but guess what? That's just going to reinflate house prices. This is the all clear for buyers to come in, especially, cash buyers saying, hey, interest rates are coming down. Go ahead and buy. He's going to cut rates next year. Asset prices are going to rise. And so, somebody who's been trying to save up on the side to buy a house, if there's anything left of their paycheck at the end of the month, right now it's going to start losing value faster than they can save it. So I don't know what to tell that person. I'm not going to tell that person, go chase a FOMO rally in house prices. Don't go buy at all-time highs. Don't go buy at these interest rates. But at the same time, is that house going to be cheaper this time next year? It should be, but I'm not sure it will.
As interest rates come down, we kind of talked about this yesterday, how we felt that more people will come into the market. But the numbers showed this morning that people are going to buy as soon as the numbers come down too. I don't necessarily think we get the pop that we thought.
Yeah, I mean, we saw some buyers come in. We saw the refi index really surge this morning, a big surge in refinances on this drop in rates that we've seen since around Halloween. Yeah, I just don't know what to tell those people who have been priced out of the housing market. I want to say, okay, he said this thing. There's that light at the end of the tunnel. There's that Q in 6 more months. I don't know, though. I really don't know. And, well, let's get off of the home buyer for a second. Let's talk about a couple of things. There was 2 things that I put an asterisk next to that I thought were interesting. The first thing, he was asked, what explains the disconnect? And I've seen this in the press. I saw this with this ridiculous former Fed lady who says the vast majority of people are better off hard stop. And of course, when I quote tweeted her, she blocked me because these people don't want to be countered. They don't want to be argued with. The disconnect between what people are feeling, i.e. people who live on planet Earth who have no money left at the end of the month after paying for necessities. There's no money left. And that's why demand is coming down for non-essential items, because people just can't afford them. And, you know, this woman is asking about, hey, we've achieved the soft landing. How come people aren't happy? She was teeing up Jerome Powell to gaslight people, you know, as if to say, oh, we've got this data point with this cherry-picked date range that says people are better off. And Powell did not bite on that question. It was the woman. She had a very thick accent. I couldn't quite peg the accent where she was from. I don't even remember. I think she was from the Financial Times.
No, she was British.
She was British. Okay. I didn't know which part of the island was it. You know, maybe one of the Celtics. People are so sensitive culturally these days. I didn't want to guess wrong.
Having been out with a guy from Liverpool for the last 2 days, I'm acutely aware what a British accent sounds like.
Oh, acutely aware, not just aware. Tell me you've been listening to Powell without actually telling me, because Jerome Powell told us again that he is acutely aware of how painful inflation is from people. This is not just any ordinary awareness, Mitch. This is acute awareness, very, very severe, sudden onset awareness. So that's something to keep in mind. But back to the point, Powell didn't bite. You know, he said, well, you know, maybe some real wage growth might help. And even that was like weak sauce answer, but honesty from Powell, because he didn't BS people and, you know, like do what the politicians are doing. Inflation is 3.1% and your wages are growing at 4%, and therefore you're better off financially. Yeah, that may be true right now, but for the last 2 years, inflation has been virtually double, triple the rate of wage gains. And so, yeah, people are making a pittance of a recovery right now in terms of real wages, which are currently just barely outpacing inflation. That is true. But Powell knows that is a drop in the bucket compared to what people lost in standard of living in 2020, 21, and 22. And Powell did not bite on that question. She dangled it right in front of him for him to make some kind of comment about real wage gains being this big thing and you're welcome, and he didn't do it. So I got to give Jerome Powell credit there. I am not the president of the J. Powell fan club. You guys know me. But he had an opportunity to gaslight 350 million people, and he didn't take it. And the press tried to tee him up there, and he didn't do it. So that one, I put an asterisk on that. Another one, and this question bugged me. I can't remember what media outlet she was from. I didn't write it down in time. But this goes for the whole press overall, the way they are frothing at the mouth, foaming at the mouth for rate cuts right now. Because keep in mind, guys, the financial press is owned by the financial industry. All right. If you want to know who these people work for, look at who owns them. Look at who advertises on them. It's all financial services firms. It's all fund managers and this ETF and this product and this bank all advertise, right? So they serve the big money, and the big money desperately wants these rate cuts because the rate cuts juice inflation. They make them richer and they make you poorer. And so they're all like, oh boy, if we get, the question was like, if the economy falls into a recession, if unemployment rises, would that mean rate cuts? And the question is, what's going on behind the curtain there? And that question is, she is asking, should this market start celebrating if we see higher employment? Should this market start celebrating if we see big layoffs, if people start losing their jobs en masse? Does that mean pile into the S&P 500 and stocks go to the moon? So, the message behind that question is, tell us, Jerome, should we celebrate pain on Main Street right now? And God, that question I'll say it, that question just straight up chaps my ass to hear that, to see the financial press like, oh boy, should we start celebrating people's pain? And I saw that from a couple of those folks, but it was the one question in particular. And the message was, let us know when it's time to celebrate higher unemployment. And that kind of messed me up. And Powell's answer to that question was basically something along the lines of, both mandates are important now. We're no longer concerned with just fighting inflation. We're now concerned with fighting inflation and maximizing employment, which I guess means it's a subtle yes. If you see unemployment start to rise quickly, that means we're going to reinflate the asset bubble and start lowering rates. So I took that away from that. There was a big non-answer. The guy from Fox Business asked, hey, all the Fed officials are saying 3 rate cuts in 2024. Does that mean there's signs of weakness in the economy? And Powell said straight up, no, there isn't. And in my opinion, that was not a true statement. You don't cut rates because the economy is doing so well. You cut rates to drive economic growth, to try to spur economic growth. You cut rates to prevent the collapse of the commercial real estate bubble. You cut rates to prevent more bank failures. These are not things that mean such a great thing for the economy. No mention of debts and deficits. Has anybody heard from the bond vigilantes? Missing? Anyone? Presumed lost, stolen, absconded? Has anybody seen the bond vigilantes for a couple of weeks now? Nothing about debts and deficits. Nothing about the fact that a lot of this economic growth this year was driven by trillion-dollar deficits, even though we're not officially at war, and even though we're not in a recession, we're still running trillion-dollar deficits, which if we do enter a recession, deficits don't get better in that scenario. So that was important. Also, the talk about reverse repo coming down.
Hold on.
Go ahead.
Yeah, well, that kind of goes with the reverse repo. We are spending right now like we are in a recession. The government is spending like we're in a recession. So they may be keeping us up right now.
Yeah, I agree with that. The government is spending like they're trying to get us out of a recession. I made some kind of comment like that on the morning live stream today. Like, we always hear about the economic recovery. I've heard about this ongoing recovery for like 20 years now. When does the recovery ever end? How come we go into the second and the third crisis while the recovery is still going on? We're spending money like we're in a perpetual economic crisis. And the crises are getting closer together, I would add, as we continue to spend and borrow and expand the money supply. And I think those two are related. It's not an accident that that's happening, because as the debt pile gets bigger and as the money supply gets bigger, the market demands more and more stimulus to keep the bubble growing. Picture yourself blowing a bubble with gum. The bigger the bubble gets, the harder and harder you have to blow just to maintain the current size of the bubble. And then it does get to the point where no matter how hard you blow, the thing's just collapsing on itself. The reverse repo comment, that was interesting. We were speculating before we got going if we were going to hear about that, and we did. It was the last question. There was a question about the RRP, reverse repo, coming down so quickly. Is that going to affect when the timing of QT might change? Powell made reference to we would reach a level in reverse repo, and then he said QT would slow before stopping. So right now the target is somewhere around 95 billion a month in quantitative tightening. So I'm assuming we're going to get to some point. I mean, today in the press, they were speculating it was 625 billion in the reverse repo. I don't know if that's the level they're actually going to get to, but I guess at some point they're going to go from the 95 billion, maybe back to the 60 billion we were before that. And then, what were we? Were we 45 billion? It was like 30 billion a month in US treasuries and 15 billion in mortgage-backed securities. And then they doubled.
We're over 90 now total.
Not that we ever is over. Yes. And also notable, while they're talking about potentially ending QT, on the mortgage-backed securities front, we never really got into unwinding the MBS on the Fed's balance sheet, the mortgage bonds that the Fed owns. The total holdings have come down, but the Fed is really just letting them mature. That's just people paying down their mortgages. I mean, it's at the current rate of quantitative tightening, it'll take 30 years for that to reach zero, which, 30-year mortgages, they're just basically the mortgages, people making their mortgage payments is why the MBS is going down. So the Fed never really reduced their holdings in MBS. They never even really got started with that. It's one of the reasons why, the housing market has been so fragile, even though it hasn't crashed yet. The Fed was very careful to tiptoe around that MBS coming off of their balance sheet. They said it would slow and then it would stop, referring to quantitative tightening or money destruction. They also said that they're going to stop slightly above ample reserves. So they're not going to stop QT when they get to the reserve level they like. They're going to stop when they get above the reserve level that they like. That was interesting. I haven't heard that before. What else did they say here? Oh, they also said that they're independent tracks when he was asked about the quantitative tightening coming to an end and would that coincide with the rate cuts? And he said, no, they're on independent tracks, that one will not influence the other. So that's interesting.
Well,
we could get to a point where they're cutting rates and still unwinding the balance sheet.
Jay
Go ahead,
Powell
Mitch.
said before how much he regrets all the printing he did. So I really think he's going to keep selling, even though they're raising or lowering rates. So I think we're there for that for a while. He really wants to get that balance sheet down, but he needs to get it down under 5 trillion before the next recession hits. I don't think he's going to make it.
And let's look at that real quick. The Fed's balance sheet right now, because when you said 5 trillion, right now we're at 7.737 trillion, and that's down from just under 9. So, that's 5 trillion is a long way to go. Now, where'd you get the 5 trillion number from, Mish? Is that just the pre-COVID level?
No, it's kind of the concept of every time you print, you have to print an order of magnitude higher. So if you're at 5 trillion, you probably have to print 10 trillion. And that's it. It's a little arbitrary, but that's kind of where if they're going to print and keep it under 10, they got to get under 5.
And just to put that in perspective, September 16th of 2019, right? The day before repo madness, we were at 3.76 trillion on the Fed's balance sheet. And now we went as high as 9, and now we're back down to 3.7. But we are still double the amount of assets sitting on the Fed's books that we were heading into this crisis. Remember, guys, the Fed started buying up assets before COVID. Before the first person got sick, the Fed was already printing money. That started in September of 2019. And
a lot of people forget, we had already turned the corner in 2019. We were headed down into recession before 2019 was ever done.
And I would add, while that was happening, stocks were going straight up. Stocks were going straight from September 2019 pretty much until the end of January 2019. Stocks just went straight up, even though supposedly everything in the plumbing of the banking system was in trouble at that point. And it just goes to show you, when the Fed is injecting liquidity, it's the all clear to the market number go up. But, looking at this chart, let me zoom all the way out on this chart. Right, this chart goes back to 2004. All right, right around just after the dot-com bubble. Here's what the number of assets on the Fed's balance sheet was. Does this chart look like the Fed is almost done reducing the number of assets on their balance sheet? Does this look like they're almost done, or does this look like they just started yesterday? And keep in mind, guys, look how little reduction we had in 2017, 18, 19. Look how little reduction we actually made. This was the last time the Fed did QT. They made it from about 4.4 trillion down to 3.7 before they had to turn the printers back on. And now here we are. We made it from 8.9 down to 7.7, and we're already talking about spinning them back up again soon. So how big does this thing go in the next iteration? How high does inflation go the next time around? And keep in mind, guys, in the 1970s, there was 3 distinct waves of inflation in the 1970s. You know, it came up, it spiked, everybody panicked, and then it came back down. They declared victory prematurely, and then it shot up higher after that. It did that 3 times through the 70s before Volcker finally got it under control. Is that what we're heading into this time? I mean, how bad does it get? Inflation got to 9% this time around. How bad could it actually get this time? Speaking on the, we got a couple of questions, super chats while Powell was talking. I got this one from Daniel Brent. Daniel is saying the Dixie is down and the yen is up, which is expected. We saw the dollar get a lot weaker on the dovish Powell comments. Now he's asking, can you explain why the Philippine peso versus the U.S. dollar is breaking that trend, weakening 1-to-1 alongside the U.S. dollar? Niche question, I know, but you have a smart audience. I do have a smart audience here. Go ahead, Mish.
I was going to say, I have an answer for that if you want.
Please. Yeah.
All right. So there's a couple things at play here. One is the crypto. They're getting out of the peso, going to the crypto, so they're going through the dollar. I got it. I don't think that's the big driver. Part of the problem is that they are a protectorate of the United States still. And so they are loosely linked to the dollar economically. And also the United States just basically signed a contract to build 5 more bases there, or build 5 bases in the Philippines. So what you're seeing is an economic system tied to another economic system and feeling the heat.
Just the I guess entanglement is the word. The U.S. and the Filipino economies are so closely intertwined that you might see
it's a lot like Puerto Rico. You just don't hear as much news about it.
Yeah. If Puerto Rico were to have its own currency, for example, it would probably trade in lockstep with the dollar. You'd probably see it pretty closely.
So that's my opinion.
Yeah, that's pretty good, and good point about the expansion of the military bases in the Philippines. By the way, see also some comments I made about the blind march into war earlier today. But another thing I did some quick searches while they were wrapping up there at the end, and the Philippine Central Bank is expected to do the same thing tomorrow that the Fed just did. The Philippine Central Bank has their policy meeting tomorrow, or the announcement of their policy meeting, and they are expected to also make no change. So much like you're saying, Mish, closely intertwined, 1-for-1 with the U.S. dollar. Our central bank does X, the Philippine Central Bank does X. That might explain why the Philippine peso is moving in lockstep with the dollar here, Daniel. That's a very specific question that hit me like a ton of bricks, because the Philippine peso is not something I typically track or follow on this channel. So thank you, Mish, for helping out with the answer to that one. That was a good question. And you're right. I do have a smart audience, because I think the audience on a lot of other finance channels would never even think to ask a question like that. So you guys are holding my feet to the fire here. Thanks for keeping me sharp here. I appreciate the super chat, Daniel, and the very well-informed question. Thank you, sir. And thank you, everybody else who left comments while we were up, notably the Taylor Swift comments that gave me a good laugh. and this one from JJ Watt cracked me up also when I saw this. He says, Jack, can you fix the audio? The only sound I'm hearing is Zerpenburr. And I get this question sometimes, guys. Zerpenburr, that is my euphemism for easy monetary policy. ZERP stands for zero interest rate policy, i.e. lowering rates. And Burr is the sound J-Pow's money printer makes when he prints dollars, when he waxes quantitatively. So Zerpenburr is my euphemism for easy monetary policy. I just think it sounds better than more accommodative monetary and fiscal policy. I just think Zerpenburr rolls right off the tongue a lot easier. I'm going to get that put on a t-shirt, by the way. Get your Zerpenburr t-shirts just in time for Christmas. That's about all the notes I had, guys. I mean, the big takeaway here, WWW, that's the most dovish I've seen Powell since at least November of 21. The tightening is pretty clearly done here. He paid some minor lip service that maybe more tightening would be appropriate, but I think he just kind of had to say that. If you're a hawk, if you were looking for something hawkish, if you were looking for a reason, you didn't get it today. I can tell you that. I was all ears. I didn't get it. The addition of the word any additional tightening, as if to suggest there probably won't be any additional tightening. That was my takeaway, Mish. Any other things you think you want to we skipped over? Maybe something I missed there?
Just the volatility. Yeah, I talked about it in chat this morning, but everybody be careful because we're going to see high volatility today. I think we'll see it again today and some tomorrow.
Yeah, and there's a lot of talk on FinTwit about volatility, as in the VIX. And I'm not going to get too much into it, but right now, short vol is all the rage in a lot of the hedge funds. Everybody's short volatility. It is a very crowded trade. The VIX is very, very low here. It is going almost nowhere. And Volmageddon, I think it was 2018, a lot of funds blew up when everybody in Wall Street was short volatility in 2018. That wiped out a lot of people. Short volatility is a trade where you are picking up pennies in front of a steamrollers. When it goes south, you get crushed. And everybody and their brother is short vol right now. That's something to keep an eye on. Now, today is not going to be what blows up the VIX. If you were looking for Powell to juice the VIX today, you didn't get it because number go up, man. Look at that, 4,700 on the S&P 500, guys. 4,700. We are probably heading for an all-time high here. I mean, let's look at a 5-year chart. We're right there. We're only about 50, 60 points short of an all-time high in the S&P 500. Look at gold, $43. This was, I think, February gold futures up $43 since Powell started talking, still going up. The Dow, 37,038, up 460 points today, still going up. The dollar getting crushed, down 83 basis points. It's clawing back a few points now. It was down over 100 basis points, but still way down from where he's talking. The NASDAQ, 14,700, up almost 166 points today, over 1% higher. And silver, congratulations to the stackers. You got $1 out of this one. The price of the shiny is up over $1 since Jay Powell started talking today. So, guys, inflation is coming back. It starts in assets. Remember that. Inflation begins. It follows a very predictable path. Assets. Then it hits consumer prices. And lastly, it hits wages. And we're declaring victory over the last round of inflation just as it starts to affect wages. And already we're seeing the next round of inflation in asset prices as everything is going higher today. And you folks who are waiting to buy a house, guys, I would love to give you some good news, but it did not come today. Homes are going to become less affordable after this. Yeah, the rate's coming down. Maybe that'll help with the monthly payments. But I think there's a lot of people are just going to come in. The buyers are going to come in and bid up prices, and it's going to more than offset that. So I just don't know what to tell you, housing bulls, or you people, millennials, Gen Zers who've been priced out of the housing market. I don't know what to tell you. If you're lucky enough to own a home, cling to that thing, guys, because if you're waiting for a housing crash, it ain't coming today. That's for sure. All right, guys, I want to say thank you so much to everybody who joined us today. Please, if you're new to the channel, hit that subscribe button. We do that every time Powell takes the stage. We'll be back tomorrow morning for our morning live show, the Morning Update Live. We do every day. And thank you to my Patreon supporters for everything you guys do for the channel. We'll be doing our weekly Zoom get-together over Patreon at 7 p.m. Eastern time tonight in just a few hours, where we'll talk more about what we just saw. Hi, Mom. Hi, Dad. I love you guys. Thank you to Mish and all my Blue Wrenches for keeping everything neat and tidy in the chat. Until next time, live small and dream big.